China Minsheng's shadow banking web collapse. In the gleaming towers of Beijing's financial district, China Minsheng Banking Corporation held a special place in the nation's economic hierarchy. Founded in 1996 as China's first privately owned commercial bank, Minsheng represented a bold experiment in the country's state-dominated financial system. With registered capital of 4.36 billion yuan and backing from influential private entrepreneurs, the bank was meant to showcase how private enterprise could thrive alongside state-owned giants like Industrial and Commercial Bank of China and China Construction Bank. By 2018, Minsheng had grown into one of China's largest banks, with assets exceeding 6 trillion yuan and over 130 branches across major cities. The bank's wealth management division had become particularly profitable, offering high-yield investment products to wealthy clients seeking returns that traditional savings accounts couldn't match. What investors didn't realize was that beneath Minsheng's respectable facade lay a web of shadow banking activities that would eventually unravel in one of China's most shocking financial scandals, exposing how desperate pursuit of profits had corrupted the institution meant to be a model for private banking success. The shadow banking scandal at China Minsheng centered around a sophisticated scheme involving fake wealth management products that bilked investors out of over 30 billion yuan between 2016 and 2019. The fraud was orchestrated primarily through the bank's Beijing branch, where senior managers created fictitious investment vehicles promising annual returns of 8 to 12% to wealthy clients. These products were marketed as low-risk investments backed by government bonds or blue-chip corporate debt, when in reality the funds were being funneled into unauthorized private equity investments, real estate speculation, and in some cases simply stolen outright. The scheme relied heavily on China's vast shadow banking network, where financial institutions operate outside traditional regulatory oversight through trust companies, asset management firms, and other non-bank entities. Minsheng's executives partnered with external trust companies and private fund managers to create complex investment structures that obscured the true destination of investor funds. Documents later revealed that bank officials forged regulatory approvals, created fake contracts with non-existent companies, and used sophisticated accounting tricks to hide the scheme from both investors and bank auditors. The fraud was enabled by China's relationship-based business culture, where wealthy investors often relied on personal connections with bank managers rather than conducting thorough due diligence on investment products. At the heart of the scandal was Zhang Songfen, a former branch manager at Minsheng's Beijing Sihui branch, who masterminded much of the fraudulent activity over a 4-year period. Zhang exploited her position and relationships with wealthy clients to sell them investment products that existed only on paper, using her credibility as a bank official to convince investors that their money was being placed in legitimate bank-sanctioned vehicles. She worked closely with external accomplices including Lu Jun, a private fund manager who helped create shell companies to receive investor funds, and several trust company executives who provided fake documentation to make the investments appear legitimate. The scheme targeted China's growing class of high-net-worth individuals, many of whom were business owners and entrepreneurs looking to diversify their wealth beyond traditional bank deposits. Zhang and her co-conspirators took advantage of these clients' limited financial sophistication and their trust in Minsheng's reputation to sell increasingly complex products with promised returns that should have raised immediate red flags. Internal bank documents showed that Zhang had been flagged multiple times by compliance officers for irregular activity, but senior management either ignored these warnings or actively participated in covering them up to protect the branch's profitable wealth management business. The collapse began in late 2018 when several large investors became concerned about delayed payments and inconsistencies in their account statements. Wang Jing, a Beijing real estate developer who had invested 50 million yuan in what he believed was a government bond fund, discovered that the investment certificates provided by the bank contained serial numbers that didn't match any legitimate products in regulatory databases. When Wang demanded explanations from bank officials, he was given evasive answers and promises that temporary processing delays would soon be resolved. Word of these problems spread quickly through Beijing's tight-knit business community, and by early 2019, dozens of wealthy investors were demanding access to their funds and threatening legal action. The bank initially tried to contain the crisis by using funds from new investors to pay returns to existing clients in a classic Ponzi scheme structure, but the mathematics of the fraud made this approach unsustainable as redemption requests accelerated. By mid-2019, it became clear that much of the 30 billion yuan in investor funds had simply vanished, either stolen outright or lost in failed speculative investments that bore no resemblance to the conservative products originally promised to clients. China's banking regulators moved swiftly once the scope of the scandal became apparent, launching a comprehensive investigation that revealed the depth of Minsheng's involvement in unauthorized shadow banking activities. The China Banking and Insurance Regulatory Commission found that the bank had systematically violated regulations governing wealth management products, including selling unregistered investment vehicles, failing to segregate client funds, and providing false information to both investors and regulators about the nature of these products. Investigators discovered that senior executives at multiple levels of the bank had knowledge of the fraudulent activities, but failed to stop them due to the enormous profits being generated by the wealth management division. The regulatory probe revealed that Minsheng had been using a practice known as channel business, where banks partner with trust companies and other shadow banking entities to circumvent regulatory restrictions on direct lending and investment activities. This allowed the bank to offer high-yield products without technically violating regulations, but created a complex web of relationships that obscured risk and enabled fraud. The investigation also uncovered evidence that Minsheng had been manipulating its financial statements to hide the extent of its shadow banking exposure, using off-balance sheet vehicles to make its risk profile appear more conservative than it actually was. The regulatory response was severe and comprehensive, reflecting Beijing's growing concern about risks in China's shadow banking sector. In November 2019, the CBIRC imposed a record fine of 558 million yuan on China Minsheng Banking for its role in the scandal, while also banning dozens of senior executives from working in the financial industry. Zhang Songfen and 7 other key participants in the fraud were arrested and charged with financial crimes carrying potential prison sentences of up to life imprisonment. The bank was ordered to compensate affected investors, though the complicated nature of the fraud meant that many clients recovered only a fraction of their original investments. Regulators also imposed strict new oversight requirements on Minsheng, including mandatory approval for all wealth management products and regular third-party audits of the bank's shadow banking activities. The scandal prompted broader regulatory changes across China's banking sector, with new rules requiring stricter segregation of client funds, enhanced disclosure requirements for investment products, and tighter controls on banks' relationships with shadow banking entities. The People's Bank of China used the Minsheng case as a warning to other financial institutions, making it clear that the era of regulatory tolerance for risky shadow banking activities was ending as authorities prioritized financial stability over rapid growth. The broader implications of the Minsheng scandal extended far beyond a single bank, highlighting systemic problems in China's approach to financial regulation and the risks inherent in the country's massive shadow banking sector. At the time of the scandal, China's shadow banking system was estimated to be worth over 100 trillion yuan, representing nearly 90% of the country's GDP and making it one of the largest such systems in the world. The scandal demonstrated how traditional banks had become deeply intertwined with shadow banking entities, using these relationships to circumvent regulatory restrictions while exposing themselves and their clients to enormous risks. It also revealed the inadequacy of China's investor protection framework, where sophisticated financial products were being sold to clients who lacked the knowledge or resources to properly evaluate their risks. The case highlighted the dangers of China's relationship-based business culture in financial services, where personal connections often substituted for proper due diligence and regulatory oversight. International observers noted that the Minsheng scandal was symptomatic of broader structural problems in China's financial system, including moral hazard created by implicit government guarantees, inadequate corporate governance at state-influenced institutions, and the challenge of regulating complex financial products in a rapidly evolving market. The aftermath of the scandal continued to reverberate through China's financial system well into 2020 and beyond, as regulators worked to rebuild confidence in the banking sector while implementing comprehensive reforms to prevent similar frauds. China Minsheng's reputation never fully recovered from the crisis, with the bank struggling to attract new wealth management clients and facing ongoing scrutiny from regulators and investors. The bank's stock price fell by more than 40% in the 2 years following the scandal's exposure, while its wealth management business shrank dramatically as clients withdrew funds and sought alternatives. Several senior executives who weren't directly implicated in the fraud nevertheless lost their positions as the bank underwent a comprehensive management overhaul designed to restore credibility. The scandal also had lasting effects on China's broader wealth management industry, as investors became more cautious about high-yield products and demanded greater transparency from financial institutions. Regulatory data showed that the overall size of China's shadow banking sector contracted significantly in the years following the Minsheng scandal, as both banks and their clients became more risk-averse in the face of enhanced government oversight. The case became a cautionary tale taught in business schools across China, illustrating how rapid growth and inadequate controls could destroy decades of reputation building in a matter of months. The China Minsheng shadow banking scandal ultimately stands as one of the most significant financial fraud cases in modern Chinese history, representing both the dangers of unregulated financial innovation and the challenges facing regulators in a rapidly evolving economic system. The 30 billion yuan in investor losses made it one of the largest bank-related frauds ever prosecuted in China, while the sophisticated nature of the scheme demonstrated how traditional regulatory approaches were inadequate for monitoring complex shadow banking activities. The case highlighted the fundamental tension in China's financial system between the government's desire to maintain control over capital flows and the market's demand for innovative investment products offering higher returns than traditional savings accounts. It also demonstrated how the pursuit of short-term profits could corrupt even well-established institutions, as Minsheng's transformation from a respected private bank into a vehicle for fraud showed how quickly corporate culture could deteriorate under pressure to generate returns. The scandal's impact extended beyond China's borders, contributing to international concerns about the stability of Chinese financial institutions and the transparency of the country's regulatory system. For Chinese policymakers, the Minsheng case provided valuable lessons about the importance of robust oversight frameworks and the dangers of allowing shadow banking activities to grow without adequate supervision. Today, the scandal remains a defining moment in China's financial history, marking the end of an era of rapid, loosely regulated growth and the beginning of a more cautious approach to financial innovation that prioritizes stability and investor protection over pure profit maximization.